Cheviot's Markets Uncut podcast, your weekly insight into the topics and issues that we have been discussing here at Quilter Cheviot. I'm Darragh Moore, investment advisor based out of our London office, and with regular commentator and head of fixed interest research Richard Carter taking a well-deserved break, I'm delighted to be joined this week by investment strategist Tim Armitage. Good morning, Tim. So last week, market sentiment was shaped by the ongoing US-China trade negotiations, the US government shutdown, and a mix of corporate earning results across the tech and banking sectors. Netflix saw around a 10% decline in its share price following its miss on earnings, which was mainly caused by a one-off tax dispute in Brazil. Tesla was the first of the Mag 7 names to report earnings this season. Whilst they beat revenue expectations, they posted a larger than expected decline in profit, with earnings per share down 31% year over year, weighed down by a surge in operating expenses. We also saw strong Q3 results from Barclays and NatWest, with both banks raising their full-year guidance for 2025, which is pleasing to see, especially with the recent news around some of the regional banks in the US. Now, moving to the macro, and Tim, I'll bring you in here if I can. We saw inflation data in the UK released last week, and CPI reading for September remained at 3.8%, lower than the 4% estimate. This is pleasing to see, especially for Rachel Reeves ahead of next month's budget. But Tim, what do you think this means for future rate cuts by the Bank of England? And do you think the softer print will impact next month's budget?
Yeah, that's right. It's definitely positive that the September print came in a little bit lower than the 4% expected number. So it's been 3.8%. That's an annualized number for the last 3 months. It still sounds like a very big number, given that the Bank of England's target is 2%. But we know that there are a number of policy-related one-off drivers from the last budget that have contributed to that level, and we should start to see some of those fall out over the next few months. I think actually that the fact that headline inflation hasn't reached that rather scary sounding 4%, that's definitely seen as a positive and has been a relief. One kind of looking into the data a bit more, falling food price inflation was one of the reasons why inflation didn't rise as much as expected. So it's fallen from 5.1% to 4.6% on an annualized basis. So that's still very high, of course, but positive to see that it's rising at a slower rate. So yeah, as I mentioned, headline inflation is expected to fall from here. So we're probably past the worst in the UK. Because of that, markets have started to increase their bets that there'll be one or more cuts to the Bank of England's base rate by the end of the year. Futures markets are currently pricing around a 25% chance of a cut at the next meeting in November. That will come before the budget, though, of course, which is on the 26th of November. So the falling food price inflation that I mentioned, that might encourage Rachel Reeves to increase business rates on supermarkets. But the Treasury has said that fighting food price inflation is a top priority, and so that may not happen. It would be really interesting, though, to see if she decides to increase income tax. That would be breaking one of the party's key election pledges. But there is a £22 billion hole in the public finances, so tax rises are likely, and that hole has to be filled somehow. But I think perhaps more interestingly will be the Bank of England's reaction to the budget. If there are any disinflationary policy announcements, then we may see that additional cut come in December. So probably less likely in November, but still a chance for one more cut this year in December.
Great, thanks, Tim. Good news on the rate cut front, and it will certainly be interesting to see what next month's budget holds. Now, moving to the States, inflation rose slightly less than expected to 3% in September, although it was higher than August 2.9% reading. Markets are still expecting a 25 basis point cut at this week's Fed meeting. So, Tim, do you think this will be the case, i.e. the 25 basis points cut? And have we started to see the effects of tariffs come through in the US inflation data?
Yeah, quite a different picture in the US. The market's pricing in 2 cuts before the end of the year, and actually 4 cuts to the kind of policy rate by the middle of next year. I think it would be a shock if the Fed didn't cut by sort of 1 notch this week. There are all sorts of things going on in the US, of course, but one of which being the shutdown. We'll come to that later, but we did get a US CPI print for September last week, albeit delayed. And as you mentioned, it was slightly softer than expected. That's both the headline and the core number that was slightly lower than the market was expecting. Again, looking under the hood, it was mainly driven by slowing growth in owner equivalent rents, but there are still price increases in a few of the more tariff affected goods categories, things like motor vehicle parts, equipment, apparel, and so on. So it's not all positive news. So for the moment, while we still expect the shutdown to continue and the lack of official data to continue, we think that it's likely that the Fed will cut, but we might not get too much in terms of positive or negative steer from the comments that come from Fed Chair Powell after the meeting. As I mentioned with the data, so the September CPI number was a special case. So some of those federal departments that had been furloughed were brought back into action just to make sure that number was calculated, because it's used for lots of forward-looking calculations on federal payments that are inflation adjusted. It's very unlikely that we're going to get the October and maybe even the November number, depending on how long the shutdown carries on. So for the Fed, the main concern is the labour market. And over the last few months, we've seen weaker data there and some downward revisions as well. But at the moment, they're effectively flying blind. So in terms of the impact of tariffs, we've always expected that there would be a delay. So companies filled their warehouses prior to Trump imposing those tariffs. So there were very high levels of inventories, and those have been being run down. And it's really at the point where we start to see those inventories running out that we might start to see some more price pressure in the US. So the chances are that we'll see US inflation remain relatively sticky at around 3% for a while.
Great, thanks, Tim. You mentioned that the US inflation print was actually due to be released the week before. However, it was delayed due to the ongoing US government shutdown. Please, could you provide us with the latest on this, and are we any nearer to a resolution?
Yeah, that's right. So we're now in the 25th day, I believe, which makes it the second longest government shutdown. That was after there was a 35-day shutdown in 2018 going into 2019. So as I mentioned, some of those agencies that are responsible for economic activity indicators, so the Bureau of Labor Statistics, the Bureau of Economic Analysis, the Census Bureau, they've all suspended data collection and distribution. So there's very little by way of inflation data, by way of data around the jobs market. And as I said before, the September number was a special case. In terms of how long we expect it to go on, I think both sides remain quite stubbornly entrenched. So your guess is as good as mine, I think, for now. What's been really interesting, though, is how little market reaction we've seen so far. Although the longer we don't see those really key economic indicators come through, then that may change.
Thanks, Tim. As I mentioned earlier, the ongoing US-China trade negotiations was a key topic for markets last week. However, it seems like negotiations have progressed, and there is more of an optimistic tone this morning. Tim, could you please provide us with the latest on this?
Yeah, absolutely. There was some more positive news on that front over the weekend. So it sounds as though there's been initial consensus reached on a variety of different issues, from fentanyl tariffs, agricultural trade, export controls, rare earth export controls from China. So that's been one key point of contention. It looks like those controls have been deferred for a year. And it sounds as though China have agreed to substantial US soybean purchases as well. All that means that the threats from the US of 100% tariff increases on a kind of sort of blanket for China have all but been removed. So Trump and Xi are due to meet on Thursday at the APEC summit, and we'll get a bit more information about anything solid after that meeting, hopefully. But markets have definitely taken the news positively. Equities, so stock prices are up, and bond yields are also up broadly this morning.
Great, thanks, Tim. Yeah, as you mentioned, Asian equity markets have certainly responded positively to the news. US futures are also up this morning, which again is promising. And sticking on Asia, last week Japan announced their first female Prime Minister, Sanai Takaichi. I know Donald Trump is currently on his way to meet her, and there's been a lot of strong momentum behind the Japanese equity market of late. But do you have any initial thoughts on her election?
Yeah, this is really interesting. Given Japan has been quite a different situation to other major economies, of course, really positive from the angle of social progression as well. From a policy perspective, though, so Takaichi is a keen advocate of aggressive fiscal policy, what she calls a high pressure economy, and that there's implicit in that is kind of stock price increases and a decline in overall net debt to GDP. And we've seen, as you mentioned, that the stock market really sort of rally on recent news. I think from our perspective, the key is really how much the yen continues to move. So given that these policies are likely to be pursued at a time when there's chronic labour shortage, high and still rising inflation, and an already weak currency. So Japanese equities so far have liked the outcome, but from a foreign investor's perspective, the falling yen has taken a bit of the shine off that performance so far.
Thanks, Tim. And finally, some of the largest market moves last week came from within commodities. So we saw both precious metals and oil having sharp bouts of volatility. Brent crude oil rose approximately 7.5% after the US announced sanctions against Russia's two largest oil companies. We saw gold fall by about 3.5% last week, and that weakness looks to have continued this morning as it is down by another 1.5%. Tim, how significant do you think the recent pullback is after such a strong run?
Yeah, this is an interesting one because obviously precious metals, gold and silver, have been on a real tear over the past year. For gold, a lot of that price increase has been driven by foreign central banks diversifying away from US treasuries and dollar denominated securities. More recently, though, that rally has been given an extra leg by ETF purchases. So both institutional and retail investors, I guess, buying into the rally. You could take that as being more speculative in nature. So it's interesting, really, that we saw such a large sell-off, one-day sell-off last Tuesday. It was actually the largest decline since August 2020, and silver so gold was down 5%, silver was down 7%. So yeah, large moves. There was no real clear driver, which again makes suggests that perhaps it's just a pullback from that sort of recent more speculative behavior. Yeah, so I think that's really the key. So with a 2-month gain of over 30% in gold prices, you do often see large pullbacks as some investors see that as an exit point.
Thanks, Tim. Yeah, it'll be interesting to see whether some of the banks will reform some of their or change some of their price targets. I know quite a few of them have upped their price targets for 2026. So keep an eye out for that. But Tim, thank you so much for your insights today. Very helpful. And before we draw to a close, if any listeners have any questions they would like to ask one of our analysts for a future podcast, you can put your questions forward to our team of experts by submitting them via the weekly comments page on our website. We'd absolutely love to hear from you. To stay up to date with our thoughts on markets and current issues, please visit our website at www.quiltercheviot.com. Here, you can also see more of what we are doing at Quilter Cheviot, as well as watch past webinars on demand and subscribe to our weekly comment newsletter. We'll be back again next week, and in the meantime, for those of you on social media, you will be able to see up-to-date content via Facebook, Instagram, and LinkedIn pages. Thanks again to Tim for your time today, and thank you all for listening.